Well, good evening from the part of the world I'm in today. I am in South Africa in the middle of a beautiful wilderness area. I'm here taking some much needed break and relaxation with my family, but very excited to be doing this power hour on WealthE Wednesday, the 10 mistakes to avoid when investing. So it's a real privilege to have you here with us. The first thing I must say, Lee, is firstly welcome, but also a huge congratulations on a job well done as head of community. Tonight's webinar is crowded. We have people dropping in from all over the world. Your efforts to keep our community engaged and letting them know what we're doing is working. In Dubai on your side tonight.
Yep, I'm coming to you from Dubai. It's been a fantastic second day of October. The wind has come and the humidity has disappeared, and we are all breathing a sigh of relief. We're excited to find out what mistakes there are to avoid. I'm sure that there are millions that we could discuss. As you said, we ran the survey. We asked people to give us their 5 top mistakes that they thought that they made or that they perceived were the top 5 mistakes. And it was really interesting to read the comments that came through and what people actually thought. So I think we might have a few follow-up webinars. We can release a whole lot more of those mistakes in the next couple of months.
Thank you, Lee. Great to have you. And then welcome to Alex. So tonight we want this to be really informal. So what we've done is we've invited on other investors. Alex has joined us already, and Gary, we're hoping, will be joining us soon. As you guys know, the power hours are far more casual, far more about a conversation. And we try and engage different people to get their perspectives so that they can ask us questions and also add their own perspectives to it. So Alex, welcome. Maybe as a new entity for many of our community, maybe just a quick introduction. And if I may put you on the spot, how would you categorize yourself as an investor? Are you experienced? Are you new to it? What's your kind of investor on the scale of investor experience? Where would you put yourself?
I would put myself very low at the moment. I'm still very new in this game. However, I'm very excited to learn all the tricks and to know all the ins and outs of the investments and also what mistakes not to make. So yeah, I'm very excited to learn and grow and yeah, eventually become a sophisticated investor.
Brilliant. Well, Alex, welcome, and please feel free anytime tonight to drop in to ask your questions. Remember, for all of our guests tonight, our commitment on these power hours is to not get complicated and technical, but to keep it simple. However, if there are things that anyone is not understanding or would like more insight or information on, please do reach out. Alex, chirp in, but for the rest of you, there is a question box, and please drop your questions in there and we will dive in and answer them. And good evening and welcome to Gary. So Gary, great to have you on with us tonight as well. And I'm going to ask you the same question I asked Alex. Part of the reason we're expanding our panel is really to have a few different investing experience. So good evening and welcome. And where would you put yourself on the investing scale? What's kind of your are you a beginner? Are you experienced? Where do you put yourself?
I wouldn't be so bold as to call myself very experienced right now, but probably a little more than beginner, given the history in the various sort of fintech space that I've sort of played in. So yeah, at this stage, yeah, intermediate, I'd say.
Well, Gary, as an intermediate investor, welcome, and please feel free to chip in with your insights and thoughts and your experiences and where you've made mistakes in the past, as well as any questions you might have for us as we go through this. And then I would like to say a very big welcome to every one of you, our investors, our members, our communities, people who have just dropped in tonight to really try and deepen your own knowledge and learn from other people. And to introduce yourselves, what I'm going to ask is whether you can also please in the question or the chat box, drop in firstly where you're from, which country in the world you're joining us from tonight. And then secondly, what level would you put yourself? Are you an intermediate investor, a beginner investor, an experienced investor, just so that we can have a sense of who's joining us tonight. And let's give you a few seconds to do that. Lee, as those answers start coming through, can you share where are some of our investors joining us tonight from?
Absolutely. So we have got Johannesburg, Germany, Cape Town, Zimbabwe, South Africa, in general, London. So we've got London and an experienced investor, South Africa, and a beginner. At the bottom of the ladder, Greg says from Harare. Welcome, Greg. It's the only place to start. Austria, Worcester, more from South Africa. So we definitely have a mixed bag that is coming in, which is great.
Brilliantly, thank you, and welcome to all of those people who have dropped in any comments. As I've said throughout tonight, please do feel free to just ask us questions at any time. Don't wait, jump in and we will get to them. So Lee, before we kick off, can I just confirm that you're seeing my screen that says 10 mistakes?
Absolutely, we are seeing it.
All right, brilliant. So let's get going. So firstly, as many of you know who are part of our community in many different forums, we put out a survey about 3 weeks ago, really asking our community's opinion. We wanted to crowdsource knowledge, to really understand that we have thousands of investors from around the world, some beginners, some intermediate, some extremely experienced. And we really wanted to learn from the community in terms of what you think were the 10 mistakes to avoid. So we put out the survey. We had responses from 18 different countries. We had 234 individual answers as to what a mistake in investing could be. We grouped those into 34 themes, and then from those 34 themes, we had to select a top 10. And I will be honest, it was a very difficult journey trying to select only 10 from all the answers we received. That is really what we're going to share with you tonight. Our selection of the top 10 mistakes that we got from our community and the crowd in terms of the knowledge. So thank you to everyone who participated in the survey. This is really about a community learning together. So we're very excited. Now, no surprising, the number one mistake to avoid is don't lose money. Now, for many of you, this will be a rule that you recognize, because probably the world's most sophisticated, brilliant, and successful investor, this is his number one rule. So Warren Buffett, this is his number one rule, and just in case you're not sure, his number two rule is never forget rule number one. So what does this rule actually mean? Well, basically, for him, the mistake that you can make when you're going into investing is having a mindset that says it's okay if you lose money. And what he's really trying to put across here is that investing is not like gambling. You're not going in there hoping you win big, but also knowing you can lose big. That is gambling. That's not investing. So his number one rule is don't lose money. And that's really an attitude. It's about going into every investment, no matter what you're doing, and saying, is my number one rule here being met? Am I thinking about how to first stop myself from losing money before I just focus on how I can make the money? And I think that's why for many of our investors, this came across as rule number one. Gary, I've got to ask, as a kind of intermediate investor, I know you spend a lot of time as a professional in the technology space, designing investment platforms across the board, from shared trading platforms to real estate trading platforms to a whole range of other things. How much do you think, from your experience, did this one affect you in your life?
As a start-off investor, I'm holding shares at this moment, just because to try and avoid this making this mistake myself. So I'm in a position where they went down, but you just got to hang on and wait till ride it out, basically. So I guess if you're kind of looking at things like this, you lose the money if you sell for less than you buy. So while you're still holding the securities, you've theoretically lost the value of it, but you're only going to really lose when you cash out.
Gary, great, thanks. And you know what's going to be fun is that a little bit later in one of the I think it's probably rule number or mistake number 5 or 6, there's some challenges to what you've just said. But even within the conversation the community was having, there were people challenging themselves around that. So I will remember this comment when we get to that point, because it's a very interesting one that had a lot of debate around it. Rule number 2, or sorry, not rule, mistake to avoid when investing is also, once again, you would think fairly obvious, is not starting. So absolutely, if you want to be an investor and you make the mistake of not starting, you're not going to get anywhere. Now, once again, that might sound very obvious. It might be something that every single one of us are rolling our eyes at. However, it was fascinating that this came across from our community as a major point, because so many people were saying, you know, I've wanted to be investing for the last year, 5 years, 10 years, and I just haven't got started. And so this one is fundamental. You have to get started. Now, one of my favorite quotes that I remind myself of as often as possible captures this perfectly, and it is, you have to sit by the side of a river a very long time before a roast duck will fly into your mouth. Now, this quote actually comes from Guy Kawasaki, but I think it captures this sense of, you know, I might know what I want roast duck, and all I'm going to do is sit by the side of a river and hope that a roast duck will fly into my mouth. Not going to happen. I'm going to have to get up off my backside and actually go and do something about it. So mistake to avoid is just not starting. Now, what was also interesting is when we did this with our community, how many people mentioned that the earlier you start, even if it's just with a little bit, the bigger the difference that has over your life as an investor. So no matter how old you are, you know, I know many of us are really trying to get financial literacy into our children, and we're starting early from really bringing them into the investment mind space, even if there are fun ways of doing it, but really getting people starting early. The other thing that our CEO, Scott Picken, often says is, have you got an investment plan and have you got a goal? And are you making regular, consistent investing? So my real wish, if there is anyone who is sitting on this webinar right now who has wanted to be more active in your investing for your life, for your future, for what you want, and you have not actually made the start, then I never really say this, but I'm going to say it now. Please click out of this webinar. Please leave us, go and find something, no matter how small, that starts you on your investing journey.
Now, I'd like to add into this one as well about the starting, that when you start, it can be quite daunting. And there's a lot of people who sit for ages doing hours and hours and hours and more hours and even more hours of research. And it's a thing about analysis paralysis. And so I think when you are starting out as a new investor, there is something that excites you, whether it is property, whether it is shares, whether it is ETFs, whatever it is, there's something that really makes you go, wow. And so the hardest part is taking that first step. So take the first step with the asset class that makes you feel wow, your little investment. After that, I promise you, you think, what was all the fuss about? Now I can really just sit down, have a look, and then you can make informed decisions. So anyone out there, start with something little, start with something that gets your juices going, as one of our partners, Ann Wilson, always says, and just really go for it. Don't spend too much time going, should it be in crypto? Should it be in real estate? Should it be in shares? Just find something and go for it.
Brilliant. So I want to come across to Alex. Alex is a fairly young investor, someone who's new to the game. Have you started yet?
Not yet. I'm exactly where Lee just mentioned. I'm still in doing hours and hours of research, and just understanding everything. But I couldn't agree with you more, Lee. It's just about actually understanding where you need to be and what you need to go into. So yeah, I'm very excited to start my journey with investments, and have a very big portfolio in more than one asset class. And but that's I'm excited to start, and I will be starting very soon.
So Alex, I've got a challenge for you. Luckily, you're a member of our community, so we can follow up on this. But there's nothing quite like peer pressure to inspire action. And so, guys, as I ask Alex this question, I hope all of you who are listening, you might be in the same position. Geez, I wish I had started. Alex, my question is for you: by when are you going to have your first investment done?
At least in the next 2-3 months, at least.
All right. How about we make that 2 weeks?
2 weeks. It sounds like a good idea. Definitely.
No. Listen. How about the end of October? So how about, you're part of our community. How about by the end of October, you're going to come back to us and say, guys, it's done.
Fine. Deal. We have an arrangement.
Perfect. So Lee, your comment was really exciting for me because it led into point number 3. Now, if there was one of these 10 tonight that was my favorite, it is point number 3. And it's fascinating how this came through quite regularly from our community in terms of the mistake people can make. And this is investing through the wrong investment style. So now what does this actually mean? Well, I think the point you are making, Lee, is very valid. We could read a book about Warren Buffett and how he invests. And for those of you who understand his investment style, he spends hours analyzing thousands of businesses. And he goes into deep detail, and then he chooses 3 or 4 to invest in. All right, and that is his style. Firstly, he has the knowledge, he has the experience, but he actually loves doing that. And I can guarantee you there are at least half of our community who are listening to this webinar right now who could think of nothing worse than spending their time poring over financial statements of more than a few companies at a time and spending more than 10 minutes on it. And that is perfect, because there is an investment style out there for you that still obeys the other rules, but gets you into your investment flow, that allows you to invest in a way that is successful, but is not necessarily copying how your neighbor does their investment. And I must really, the story that really brought this home for me is my brother and I, we are the same kind of age, maybe a year or so apart, normally very competitive. We have great arguments, lots of debate. About 15 years ago, he really got into his investment flow. He is now a very well-known and respected real estate investment coach. You pay a lot of money for him to help you on your portfolio, and it's great. But his strategy about 15 years ago kind of emerged for himself that he wants to be a hands-on real estate investor. And what this means is that every deal is his. He's literally got his hands into it, and he makes every decision. He goes through all the paperwork, and his golden rule is never be dependent on someone else. Okay, now that's great for Robin, my brother, because he has the time and he also has the inclination. Now that is not me. All right. I'm very passionate about the work I do with Wealth Migrate, which is far more about a financial technology solution. It is about creating a system that kind of does a very complicated dance through compliance and financial rules and real estate investing, and makes it easy for general people to invest. And that thrills me, and I will wake up in the morning excited to go and spend time on that. But as a result, I do not have time to do investment the way my brother does. And secondly, I wouldn't want to. It's not going to make me excited every morning. So for you, find what is your investment style. It might be the person who spends hours going through the finances, or it might be the person who is much bigger picture thinker and bets on trends, or is really about being a great judge of people, and therefore finds the right people to do your investment through, rather than the right set of finances to make your investment decision. So for each one of you, don't pick up a book, How to Invest by Warren Buffett. Read it, and if it doesn't actually resonate for you, think that's how I have to spend the next 10 years of my life investing. Find the investment style that works for you. Get people around you who are doing a similar style and learn from them. This was a breakthrough for me about 12 years ago after trying to do it the way my brother did, and it just didn't work because I'm not that guy. I found an investment style that has worked extremely well for me over the last 12 years, and in which I really enjoy and I'm happy in. So that's mistake to avoid, is trying to just copy the style from the person next door or the last book you read. So Alex, I guess I'm coming back to you again and asking, you were talking about your analysis paralysis that Lee was talking about. Have you got a sense of what your investment style might be as you start growing this? So are you going to be one of these guys who is a numbers person and a big, thick books of finances, or do you reckon you're more of a people person, finding the right partner who you build trust in, or, a range of other strategies?
I think it will be a mixture. I really enjoy technology, so it'll be definitely market research in terms of technology, as well as obviously partnering up with the right people and experiences. And yeah, I'm very fortunate I have you guys that I can give a call and ask questions and send WhatsApps. So I feel very yeah, I really appreciate that, and I think yeah, that's definitely the way I would go. And yeah, just start, I guess, and learn as I go.
Great. Well, remember, you've got a month. Lee and Gary, have you got any suggestions or thoughts on your personal investment styles? Have you given it some thought ever into kind of what is your approach and strategy that suits and gets you excited?
Yeah, I think from my side, like I quite like ETFs at the moment. It's an amount that I can kind of throw money at, and it kind of protects me from individual stocks. So it's something you can kind of like buy into a different market, and number of platforms out there that kind of make these things available. So you can buy into like an S&P 500 stock as well as a JSE Top 40 stock, and you can kind of decide what kind of what kind of like diversification mix you're after, like, yeah. So that's probably my what I kind of.
So Gary, for those of our attendees tonight who might not be up to date on the terminology, can you give a very quick 30-second description of what an ETF is?
Right, so it's an exchange traded fund. That's what it stands for. Basically, what it is it's a fund that lists on a stock exchange, and what it aims to do is hold a representative, hold a portfolio that's representative of the index that it's tracking. So if it's let's say a JSE Top 40 fund, for example, it would be made up of the top 40 companies on the JSE in ratio of their market cap. So that's basically, if 20% of well, it's not so much anymore, but there was a time when maybe 20% of the top 40 was Naspers, you would have 20% of your holdings in Naspers. So the idea behind it is that you're not exposed necessarily to individual stocks as much. You're tracking a market, and it's generally passive investment, which means there's no active fund manager making decisions on your behalf. So it's all based on algorithms, which makes it cheap. So there aren't big fees associated with it, which is another thing I like about it. And a lot of research shows that I think it's something like 8 out of 10 fund managers don't beat the index. So all reasons why I like it.
All right, guys. So for those of you who are listening, this is really exciting for me, because as you hear Gary speaking, can you hear his investment style coming through? He does not want to be Warren Buffett researching each individual stock. In fact, he probably wouldn't even be able to tell you what 20 of those top 40 invest in or what they do. Gary, no offense, I'm just using that as an example. And yet what you can hear is that Gary has really researched at a higher level, at a macro level. And he said, listen, I know there are a few things that are important for Gary. He doesn't want to pay middleman fees. I get it. He wants to have a technical, almost artificially driven solution that balances his risk against a whole bunch of different investments. But all Gary has to do is make one investment into that exchange traded fund. So for Gary, it's exciting, and I know a bit about Gary. He's got a very analytical mind. He's a big picture thinker. So he can make great decisions around big picture investments. Does he want to invest in the US economy, the South African economy, the European economy, and he will then buy into the exchange traded funds in those markets. And then he will have fun analyzing the data and the performance, and he can track it. But he doesn't want to be a Warren Buffett investor. So Gary, as you can hear, has begun to find his flow, his own investment style, and that's perfect. That's what we're trying to say here. Now, for those of you who get nervous, if you're hearing this and you're thinking, but I don't know what those stocks are, then this is probably not your investment style, and you need to be Warren Buffett, which is perfect because that's the point here. 10 mistakes to avoid. Number 3, investing through the wrong investment style. Lee, quickly over to you. I'm very concerned. We're only in point number 3. I'm probably being too verbose, so I'm going to speed up. But have you got an investment style that you've identified for yourself?
So Derek and I, my husband, we have a joint investment strategy. He is quite analytical and loves sitting behind the computer and looking at the share market and deciding where we're going to do our investments, and through bands. I do it through ETFs and real estate. But our main strategy is diversification across multiple investment categories, jurisdictions, currencies. That is our strategy. So we look at each thing. We have got real estate, ETFs, high risk crypto, which is very contentious at the moment, but we do have it. And for us, it was also about earning while we sleep. We don't want to do the hard work all the time, so we don't want to be hands-on. We want to earn while we sleep. So education is key, I would say. We did do things much to my disgust and yawn, like going on a trading course. Derek got fired up. I fell asleep. But you know, I look at that. I tell him where our money's going into ETFs and into real estate. He tells me where our money's going into crypto and shares, and we're all good on that front. But the one thing that I will say, which Gary has echoed, which Linden has echoed, is there's something that makes you excited. And what I can say to you is that is where you will make the most money. Have a diverse portfolio, but that's where you'll make the money.
Yeah, and guys, when we talk about your investment flow, your investment style, I think you get the picture. It doesn't mean the other 9 rules disappear, or the other 9 mistakes to avoid. So, you know, bear those in mind as we go through this. So mistake number 4 that came from our community is don't bet the farm. I think we all know this. You know, this is a fairly old saying that came from a long way back when the farm really was a representation of how you survived, how you lived. Your underlying security that enabled you to do what you needed to provide for yourself and the ones you love and look after. And the key word on this is don't bet, don't invest, don't get to a point where you are putting at risk through your investments your underlying security. So some of the other words that came through from the survey were being too greedy, investing because you had a fear of missing out, so you kept putting more. Going into debt to invest that puts you at risk. Avoid using the money before it is earned. Now that one was interesting. Obviously someone's created an investment, and the mistake they made is they thought, okay, this thing's doing so well, let me go and spend it on credit, and then it didn't come through, and in the end they were in troubles. So the real lessons here are always put something aside for investment, always. Though never so much that it puts your needs at risk. So if you're only getting $1,000 a month of income and you are needing almost every cent of that just to live, always take something, even if it's just $5, put it into an investment, but don't put in more than puts your well-being and your health and your basic needs at risk. Which pretty much leads us into number 5, Lee, coming back to your comments. One thing that came through very strongly is this idea of diversification. So avoid having all your eggs in one basket. So apologies, it seems like the farm analogies has come through in number 4 and 5. But this is the scenario where you go, this is the one, you know, let's go all in, and you take all your investing resources and you put it into one opportunity. But it goes even further than that, not just one opportunity. what about diversification in terms of assets? So we've heard both Lee and Gary say that they have a bit in real estate and a bit in shares, a bit in cash. I had a great moment in my investing journey about 15 years ago. I was listening to a webinar with a great speaker. I can't remember who it was, but I remember what he told us. And he was very clear. He said he invests under the Mercedes principle. I was like, that sounds complicated. And actually, he was just talking about the logo of a Mercedes-Benz car, because that logo is round and it's divided into three. It's got this kind of Y-shaped thing in the middle. So basically, you have three. And he says whatever he does, every 2 years, he sits down and he says 1/3 of his investments are going to be in real estate, 1/3 are going to be in shares, and 1/3 is going to be in cash. And then he rebalances it. And then 2 years later, let's say the shares have done really well, he will sell some of those to balance again. Because what was so smart about what he was saying is that when the one has done really well, that's when you take out of there and you put money into the ones that are at the bottom of their cycle and aren't doing so well. So, for example, the property or the cash. And that's a very simple formula that he always used to balance and keep his diversification of assets. Now, that was great 13 years ago, because at the time for me, it was simple. I could have a look around, I could find real estate, I could find shares, and I could have cash. But then the world changed. And what changed fundamentally was it became easier for everyday people like me to diversify globally, to not just have real estate, shares, and cash in my own currency in my own country, but now to apply that at a global scale. So to have investments in dollars, in euros, in pounds, in Australian dollars, whichever areas you want to, you can now have this opportunity to have diversification into currency as well as assets. And that has been a significant game changer for so many global investors. The mistake to avoid is having all your eggs in one basket, not only in assets anymore, but also in terms of the underlying currency that you put that in. The next diversification mistake is to only have one partner. So in real estate, this is, I think we can understand this. It's when you have one real estate company or real estate investment firm and you're always putting money into their deals. That's a mistake to avoid. Instead, really have a look around so that you are spreading your risk into real estate partners, share partners, even crypto partners, Lee mentioned, that have got different experiences and different niches. That way you're spreading your risk. And then lastly, diversify if you can into different strategies. Wow, so I feel like I've been just talking for a lot. Any of you guys have any questions or comments that you want to talk about diversification? Because it is so core to so much of the investing strategies we should be doing in 2019.
I think one of the things that you mentioned over there, just around the rebalancing side of it, is like what I tend to do as well between ETFs is maintain those ratios that you spoke of. So I would just basically determine that it's going to be, you know, if it's 50% local, 50% offshore, then that's what I would maintain. And it wouldn't necessarily be on selling down necessarily, but when I'm making regular contributions, I'm topping up the ones that are lower, so to speak, so that at the end of the contribution, everything kind of balances out. And the theory behind that being that you're buying the cheaper stuff and buying less of the more expensive stuff. So as the markets kind of move, you naturally topping up that, you know, the jar of the lower water level.
Yep, that's exactly right. That balancing is all. It helps you enter a market at the right time. So when and the irony is that this is often opposite to what the herd does, isn't it? So when something's really high and doing well, the herd decides, wow, look how great shares have been for the last 10 years. Let's all get into shares. Or if real estate has been the thing everyone's talking about, how much money it's making them, that's when the herd follows into real estate. And in a way, this balancing diversification helps you do the opposite. It's when something's doing really well, that's when you start getting out of it a little bit. You're not selling everything, you're just readjusting the ratios, and you're getting back into things that are cheap relatively. Alex, I saw you kind of looking and going, wow, I'm thinking about that. Do you have any questions on this one or anything you want to add?
No, it just makes sense what you guys are saying. It's yeah, it just makes a lot of sense, and I've never actually thought about that way. So now I've just gotten a lot of value from what you guys just said.
Brilliant, Alex. I know we have a deadline that we've self-imposed, well, that we've imposed on you. It'd be interesting in your report back at the end of the month to see what ratios you've chosen between different assets, currencies, because the exciting thing about the world we're living in right now is that every single one of us, every single person listening on this call can diversify across assets and currencies, no matter how small your investments are. There are share trading platforms that you can buy in from little as $1 at a time. Platforms like Migrate that offer you an opportunity to have a global real estate portfolio. We're pushing that down. You know, at the moment you can buy something from $1,000 into a really exciting top-class commercial real estate opportunity in different currencies. And we all know that you can set up accounts through virtual wallets to hold cash in different currencies. So there's no reason why we as investors, even beginning investors, have not diversified our portfolios, not only into asset classes, but across currencies as well. All right, let's have a look at number 6. This came across once again very strongly from our community. Don't focus on short-term quick gains, because then you're not investing, then you are likely to be trading. So understand the difference between a trader and an investor. Now, a trader is someone who has the experience and the knowledge to be able to time the market. In other words, to know today I can sell this and buy it tomorrow at a cheaper price. Or I can sell this very quickly, flip it, and then buy it again at some other time. So for people who are good at trading, there is nothing wrong with it as a strategy. However, even Warren Buffett himself, probably one of the greatest investors, has said he would never trade because he does not think he has the knowledge and experience to beat the market. In other words, to get his timing right all the time. That's why he focuses on the long-term gain. Now, absolutely, there are people who trade investments as a profession, but then their profession is not so much investing as it is being able to make judgments with very complex models around short-term changes that are going to happen in different markets. Now, for the average person, as Lee said, you know, her husband and her went on a trading course. Derek really got excited and was interested in it, and that's fine. Once again, remember diversification. However, the overwhelming consensus is if you are just wanting to be an investor, focus on long-term rather than short-term. Now, Gary, coming back to the comment you made at the very beginning, one of the comments that I found very interesting in the community's conversation that we did during the survey was that a lot of people were saying, don't switch too often. So don't go from one investment to another. And yet another part of the community was saying, know when to cut your losses. Don't hold on to something and just keep going and going, holding on when the loss is becoming worse and worse. Know when to cut it. So, you know, Gary, your comment at the beginning was really interesting for me. I think a lot of people in the crypto world who have been, I'm going to be a little bit cheeky and say maybe trading or gambling rather than investing. And I put my hands up. You know, I took a dabble with some money I was happy to lose, and I certainly gambled on a little bit of crypto, but very consciously knowing it was an opportunity to learn more than anything else. And I certainly didn't cut my losses at the right time. Where are you sitting with this at the moment?
Yeah, so I mean, as mentioned, like about 50% down, and I bought into Steinhoff on the way down, thinking it was a bargain, but then the awful truth came out, and it's now trading at R1. I think my average I bought in it was around about R2.50 or so. So yeah, I'm a bit down on that, but it's kind of like you said with crypto. I kind of viewed it as a similar sort of thing. If there's money that I didn't mind losing, the upside was justified the potential downside. So it's it's not the farm, you know. It's maybe about R1,000 worth of R1 shares now, which if they ever go up to 70 will be awesome.
And I'm
But
assuming that
if they
that's
don't,
part
if
of
they
your
go to zero.
diversification. So you've certainly got a whole bunch of other things as well, and you didn't
Yeah,
just go.
there's about there's a good couple of others, but yeah, no, I think the main thing for me on that, like, I guess I guess when you cut your losses is when you actually take them. So you still have I still have the exact same number of shares that I bought. They're just worth less at this moment, and I don't need to cash them in yet, so I won't. So that's basically my thinking on that. Yeah.
Fair enough.
You only lose money when you sell.
Absolutely. So you can hear the trader coming out in Gary and his, and his strategy there. So it's good to hear that perspective. We were slightly sneaky. We couldn't, the last sentence on the slide, understand the effects of compounding investments, was actually something we wanted to add as an 11 mistake to avoid, which was don't compound. Or avoid not compounding, the negative of compounding. But we snuck it in here because it was the 10 mistakes, not the 11. So I just want to share with everyone this concept of compounding investment. Now, I know a lot of people understand compounding interest. And so what this basically means for many of our investors who are starting out on their investment journey is that when you make an investment and you start getting returns on that investment. So let's say I've got I put money in the bank and I'm earning interest. I have a choice. I can take that interest and spend it, or I can take the interest and reinvest it. Now, when you reinvest, that is when you are compounding your interest. In other words, I've taken interest that I've earned in year one. Now I'm adding it to the amount that is then going to get interest in year two. And why I like this idea is because no matter what your asset class, whether it's shares, real estate, cash, you will see in the slide the effect of putting your money back into the system rather than taking it out. So you'll see here that after 20 years, someone who started with $1,000 investment, if they were just earning interest, they would be at 3,000. If they did not take their interest that they were earning along the way and add it back into the principal that they were earning interest on. And by doing that, taking the money that they were earning, putting it back into another investment or into new interest, they ended up on more than 100% more. So literally, instead of 3,000, this person ended up on just above 7,000. And that is, they haven't put any more money in the beginning than anyone else. It's just that they kept putting the money they were making back into their investment. And I think this is one of the key understandings that people, the mistakes people make is that when they've made money in their investment, absolutely take some out every now and then, reward yourself, invest in yourself, go on a holiday, but make sure that you're leaving a lot of your money and the money you're making inside your investment strategies, so that by the end, the same money you started with, the 1,000 that you put in at the start, can actually be more than double what you would do if you weren't reinvesting.
And Linden, this isn't a new concept. I mean, it goes back where Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. So it's been around for a long time. And it's just really coming to grips with the fact that you can earn more longer term if you just keep reinvesting.
Agreed 100%, Lee. And I think what's exciting for investors is that in the last 10 years with technology, creating investment platforms, whether it's share platforms or real estate investment platforms like ours, is that when, for example, Wealth Migrate pays someone dividends on an investment they have, that money sits on that platform and can be invested literally in the next minute back into another deal. Whereas in the past, it was easy to compound your interest in a bank account because your interest would be paid and you could have an instruction with your bank just to reinvest it. Now, because there are these trading platforms that have transactional accounts, money accounts built into them, when a share pays you a dividend, you can immediately take that and invest it in another share. Or when a real estate investment pays you dividends, you can immediately take it and put it back into another real estate project. And I think it's just made compounding that much easier to do, not only when you've got interest on money in a bank, but in all asset classes. So absolutely avoid taking money out, but that's I'm not saying don't spoil yourself every now and then. So once again, I'm feeling verbose. I feel like I'm talking too much and I'm running out of time. So let's move on to number 7. This one is something I know we at Wealth Migrate speak a lot about, in particular at the moment in terms of the economic space, but it's avoid focusing just on capital gains. And the counter to this is that cash is king. If you can have an investment that is paying you money from day one, in dividends, in rentals, in if it's shares and dividends, but that you're not waiting for 2 years before you get money back. So it's a balance between having investments that you want the capital, the underlying value to grow over time so that when you sell, you've made money, but you also want those same investments to be giving you cash back throughout that journey. And in particular, when the world economy is going into a space of uncertainty, and as many people predicting might start going down, you want to be in investments that have the ability to keep delivering cash. Why is this? Well, the answer is very simple. It comes back to that balancing. When the world's economies are about to go down, if you have cash, there are bargains to be picked up. However, if your money is stuck in the capital project that is not delivering cash, it's very difficult to pick up those bargains unless you sell your asset when it's already at a low. So you'll find a lot of our top investors who work with us at Wealth Migrate, they are all at the moment looking for opportunities, real estate, that they are happy to hold through a downturn as long as they are real estate that are focusing on rentals, on getting you income, on paying that income regularly and not waiting for only a big paycheck at the end. So a mistake to avoid when investing, number 7, don't only focus on capital gains. I'd even say the stronger from what the community was giving us feedback on is focus on income generating investments that are generating you income as soon as possible. Let's, Leo, Gary, Alex, any questions on that before we head on to the 8th mistake to avoid? Sounds like not, so let's dive into no due diligence. A mistake to avoid when investing is not doing your due diligence. So what due diligence means is basically that you've really checked, you've really gone and validated, you've made sure that both the person who is offering you an investment, the company, or the deal itself is real, the numbers are real, that you understand the market, that it's not just big promises from people who can sell you anything, but actually there's nothing underlying it. So due diligence is when you really go and scratch a bit more. Now, what's important to understand, coming back to mistake number 3, is not all of us love doing complex due diligence. It's a skill, it's a gift to really scratch deeply in the numbers, but that doesn't mean that you should not do due diligence then on the people who are advising or who are supporting or who you're going to invest through. If you know that your investment style is not one where you are going to spend hours excelling at Excel, spending time on a computer going through spreadsheets, that does not mean that you should not do due diligence on the people who you are going to trust to do that on your behalf. So always find out their track record as advisors or as a Wealth Migrate platform. You know, come and ask our platform, what is your historical record? Make sure that there is some degree that you have actually got facts that are backing up what you are going to go and do on. And coming back to the point, the most important due diligence you can do is on yourself. You are the single variable that is most likely to affect the outcome of your investment, and because you are the one who is making a decision to invest in it. So don't overestimate your knowledge. Don't necessarily try and invest in a strategy that is not yours. Really know yourself. Understand what your best route to investing is, and then follow that. If you haven't done due diligence on yourself, on how you make decisions, know your weaknesses, That will be the thing that guides you. So often we all think due diligence is about everyone else, but I can tell you from many, many people we have dealt with over the last 5-6 years of investing, the ones who struggled the most were people who did not know themselves and the way that they made decisions and put in plans to deal with that. So this is a big one. Lee, Gary, Alex, any questions or comments you want to add at this point?
I'm all good.
Okay, people shaking their heads.
No, I think
Scratching their head.
this one, this one, I think for me is like the share trading that I do is like a small portion of my actual portfolio. It's more for fun type of thing. The stuff that I'm actually, you know, the real nest egg type of stuff is around this, I guess, around the area of the due diligence on yourself. It's trying to keep your emotions and humanness away from your investments as much as possible. So it's another reason I really like ETFs, is because there are less people making emotional decisions. It's one thing to make emotional decisions with your money, but when you've got other people making emotional decisions with your money, that's when I get nervous. And again, it's a personal philosophy of mine, I suppose. It's not necessary for everyone.
All right, brilliant. So let's wrap this up. Alex and Lee, I'm going to hold on your comments because I know there are probably a lot of questions that have come through and we haven't even got to them. I've been talking too much. Apologies. So let's wrap this up because, Gary, it comes to your point. Mistake to avoid, number 9, is emotional investing. Some of the language that came through from the survey is word of mouth marketing, following the herd mentality, going for pretty pictures and big promises, following those who are not successful, accepting the first deal presented, not understanding tax implications, investing based on a whole bunch of assumptions. And really that was a bit quick, really the counterpoint to this is make decisions based on numbers, on facts. Do the calculations, know what the tax implications are, understand all the costs, know where the fees sit, evaluate the exit strategy on the deal. When is it going to be sold? What are the assumptions about it? And even if you're a beginning investor who cannot do all this work, that's fine. As we said on number 3, don't follow an investment strategy of an experienced investor if you are not yet able to. Rather, find the right people to invest with or invest through. However, do grow your own abilities over time. One of the biggest mistakes we can make, and I think we've emphasized it enough, is trying to invest in a strategy that has made someone else successful. But if you're not yet at that same place or don't have the same interests to do the work they're doing, don't follow that strategy. But always do try and grow your own abilities over time in the style of investing that really works for you. But know your numbers. Don't let investment decisions be emotional. As a counterpoint to this, I guess, the final mistake we're going to speak about tonight is giving others control of your investments. Now, what the community gave us feedback on this one is a mistake is giving financial advisors full control of your investments, not being involved in the decision making, making middlemen rich. What was interesting, there was a counterpoint to this from some of our investors who said the mistake they made was trying to do everything themselves. And I think that's a great point, because what we are talking about here is not that you have to be Warren Buffett. All right. However, even if you're using other people to support your investment journey, firstly, go back to the previous one, due diligence, make sure you've got the right people, but be involved at all times. Don't just hand over your money and then step back and 2 years later say, how's it doing? Because you will learn the more you are involved. Ask them to explain things, ask them for reports. Really make them work for their money if you're using a financial advisor or a system, but fundamentally grow your knowledge over time. So for those of you who are just starting a journey and it all is very intimidating, absolutely get help. Make sure it's the right help. Get people who can guide you, who understand tax, who understand fees, who can really explain things, but don't abdicate your own control by just saying you do it all and I don't want to know about it. That's a mistake that came up again and again from our community as something that has bitten people and really put them in a difficult place. So there's so much more we could say about this, but Lee, I'm very conscious of time, and we're almost done. And as I just put up this slide, so we've talked about the 10 mistakes, and in a way, here are the 10 principles, therefore, that come out of those mistakes. Number 1 stays the same, don't lose money. Number 2 is actually start with a plan if you can. Number 3 is find your style. Number 4, invest what you can afford. Number 5, diversify across assets, currencies, partners. Number 6 is go for the long term. Number 7 is income is gold. In particular, where we're heading for the next 5 to 6 years, income opportunities are where you want to be rather than longer term capital gain opportunities. Number 8 is do your due diligence. And if you're not the kind of person that's doing deep dive due diligence on numbers, then at least do due diligence on the people who are helping you. Number 9 is make sure you're investing by the numbers and not just the emotions. And number 10, always be involved at some level in your investment. Sure, that was, I can't believe the hour has gone. Lee, let's jump to you quickly. I know we've got very little time. For those of you who might need to leave, thank you very much for joining us. For those of you who can stay on, I commit to staying on until all the questions are answered. And for those of you who have to leave, who have only booked an hour of your lives to be with us, apologies if we haven't got time to do the questions while you're with us. We will send out a recording. With that being said, Lee, let's jump across. Are there any questions that have come through or any comments that you want to share from our attendees today?
So there are no questions through yet. So if anyone does have a question, please just pop it into the question box and we will get those answers. But a very interesting comment has come through from Pat around our discussion on compound interest. And he says for him, he has found that compound interest works only when you don't have to pay taxes.
Yeah, that's a great comment. Absolutely true. And what's really interesting is that there are some, so once again, I don't want to get too technical tonight. We're trying to keep it light and airy. But for example, in the States, when you have real estate capital gains, you can actually delay paying taxes. So what that means is that you can use the compounding investment in real estate and keep delaying the capital gains tax and push it back and back and back 20 years, 30 years, using that money to make even more money, but you only have to have a tax piece on it much later in the investment journey if you opt to use this particular exemption, for example, in the US. So 100% compounding is impacted by taxes, and there are investment opportunities out there that allow you to keep doing compounding. I know, for example, in South Africa, Gary, I'm sure as a sophisticated investor will tell you this, that there are some investments in South Africa where there are tax exemptions, where you can spend so much every year and they will not count for tax, so that you can keep compounding that investment without having to pay tax on it. So absolutely, tax does have an impact on compounding, but there are ways that you can, within the laws, because we certainly are not advocating anyone breaks the laws, but that you can make use of compounding as an investment strategy. Any other final comments? Alex, sorry, before we come to Alex and Gary, Lee, anything else from our community tonight?
There's nothing else from our community. I think they are all trying to digest everything that has been said tonight, and because there was a lot of information shared.
Indeed. So in that case, as a part of wrapping up, what I want to do is quickly go to Lee, Alex, and Gary. For each of you, your top 2 out of the list of strategies, principles to follow to avoid making mistakes, what would your top 2 be from the ones we've talked about tonight? And let's start with Alex. Alex, from what you heard tonight.
I think mine would definitely be number 3, is finding your style. I think I want to focus very heavily on that, is finding my flow in terms of investing. So that's one of my key areas where I want to focus on. And number 8 would be the due diligence in terms of understanding what to look for, what parts of investments to look out for. And yeah, those are my 2 big core focuses at the moment.
Great, thanks, Alex. Gary, over to you. What would your top 2 be from the list?
Yeah, so I think my top one is basically starting. Interestingly enough, Alex and I were actually just talking about this earlier today, and I showed him a spreadsheet of my own that told him that if he were to save 1,000 Rand a month every month for the next 40 years, if he starts when he's 25, he will have, I think it was 5.3 million, and if he starts when he's 26, he'll have 4.8 million. It's $500,000. So that's the difference a year of starting early makes, and so hopefully he does take that challenge to heart. So that's the first one that I said. Like, the earlier you get started, obviously the better. And the second one is that's all about the long-term bit of it. So leading the compounding work for you, and I guess it's that understanding that where those tax sort of opportunities kind of lie. Like the big one that I'm using at the moment is this tax-free savings account that they have in South Africa, which actually allows you to go with ETFs around, and that's all the growth in that is going to be tax-free basically. So yeah, building that out at the moment.
Brilliant, Gary. Thank you for joining us tonight. Lee, your top 2?
So my top 2 is diversify. Seriously, diversify, people, all of you. And then invest by the numbers. It cannot be emotional. It definitely has to make sense. I'll give you an example. My mother loves sweets. So Sweets from Heaven in South Africa came out. She bought Sweets from Heaven shares. Okay, it was the worst thing she could ever have done. Luckily, she didn't bet the farm, but it was a completely emotional decision for her. Had she gone in with something else like an ETF or even a more stable like Ellen Gray, she would have made money. So just take the emotion out of it. Look at what's in front of you and make the decision based on the information, not on what you think is going to look good on your balance sheet.
Brilliant. Thank you, Lee. Appreciate it. So we have got quite a few comments coming in and suggestions around a follow-up that specifically deals with tax and implications, and how Wealth Migrate itself deals with tax in a global context. That is something we are working on. Expect it very soon. It might even be the next month's WealthE Wednesday. We're still kind of deciding how we want to do that, because tax can be complex, but we like keeping WealthE Wednesday to really make it accessible and simple. So thanks for those comments. We are certainly working on it. Guys, with that, I really want to say thank you, firstly and most importantly, to all the members of our community, all the people who have attended tonight. We really appreciate you being online with us. It's been great having you. And then to Lee, Alex, and Gary, thanks for being with me tonight. Thanks for contributing, for your questions, for your comments. It certainly has added value, not just me rambling on for an hour, but actually having a break. And then Lee, I want to come back because I know we have at Wealth Migrate, there's some exciting things coming up in the next. We've got a whole bunch of webinars that are really aimed at investor education and knowledge. And it's an opportunity for people to join us on those that you just want to share with us.
Yeah, thank you, Linden. So October is all about personal growth and us trying to help you as we enter the last quarter of the year. And we are going to be running a webinar series every Tuesday of the month of October, where it's all about investing offshore, creating your global platform and portfolios, how to immigrate both financially or physically. So we invite you to join those. I have put the link that you can register. It's a one-time registration for all of those webinars. They will be recorded and sent out, but you can see from the engagement that has happened on today's webinar, it's always better to be live so that you can ask your questions and get them answered. So if you would like to register, please just click on the link that I have put into the box and join us for those. They start next week, Tuesday. And then following on from that, in the month of November, we're going to be doing a roadshow through South Africa and holding some investor breakfasts where we have got some exciting guests that are coming to join us. More details about that will be released within the next week or so. So please have a look on all our social media channels and in your inboxes, because we will be sending you the information on that.
Brilliantly. Thank you very much to everyone for joining us tonight. It's really been a privilege to have you on here with us. We certainly appreciate when our community joins us and engages with us. It's really been great having you. Once again, Lee, Alex, Gary, thank you for all your time. Wherever you are in the world, we hope you have a good night or a good day if it's early and on your side. And certainly we look forward to seeing you in those webinars, if not next WealthE Wednesday in a month's time. Thanks, everyone. It's been great having you on board.
Thank you. Bye-bye.
Bye-bye. Cheers.